Welcome back, everyone. I really appreciate you tuning in today. The US dollar, long considered the cornerstone of international finance, may be facing a major transformation. Economist Steven Jen suggests that Asia might soon trigger a wave of dollar selling, potentially up to $2.5 trillion. That's a massive outflow that could significantly impact global markets. So, what's causing this potential shift? Let's break it down. For years, many Asian nations have built up large trade surpluses with the US, exporting more than they import. As a result, they've accumulated vast amounts of US dollars. But instead of letting that money sit idle, these countries have invested in American assets, like treasury bonds, real estate, and stocks. According to economists Steven Jen and Joanna Frary, Asian exporters, particularly from countries involved in the US-China trade dispute, may now hold over $2.5 trillion in US dollar-based assets. Much of this is what's known as naked long positions, meaning there's no protection if the dollar loses value. And that's where the risk lies. If the dollar dips, they could face serious losses. So, why are things changing now? One key reason is politics. Under Trump's return to tough trade policies and efforts to isolate China economically, many Asian governments and businesses are rethinking their strategies. If US policy is growing more uncertain, holding such large dollar reserves suddenly seems risky. Rather than dumping all $2.5 trillion at once, we might see gradual sales. But even that could create a ripple effect. In fact, we're already seeing early signs. Bloomberg's dollar index has fallen by around 9% since January, and many Asian currencies like the Chinese yuan, Taiwanese dollar, and Malaysian ringgit have gained strength. Some experts believe this could be part of a broader trade strategy. By letting their currencies rise, Asian policymakers may be gaining more leverage in upcoming trade talks with the US. Another major factor is repatriation, the return of money to its home country. Steven Jen estimates about $1 trillion could flow back into China as companies pull out of dollar-denominated investments, especially if the US Federal Reserve continues to cut interest rates. Lower yields reduce the incentive to keep money in US assets, and that could cause a chain reaction. This isn't just a minor trend, it could be a tidal wave. If more Asian nations follow China's lead, the dollar could come under serious pressure. A weakening dollar could mean more expensive imports for Americans, pushing inflation even higher. At the same time, US bonds could be sold off, and central banks might have to take action to steady their currencies and interest rates. We might also see global investors shift their focus, moving away from the US dollar and toward emerging market currencies, digital assets like Bitcoin, or alternative stores of value. The US dollar has long enjoyed its role as the world's reserve currency, a status that has given it a huge advantage in global trade. But that privilege isn't permanent. History shows that reserve currencies can and do fall out of favor. And many believe the dollar could be next. So, what should we be watching? Trade policies. Any increase in US-Asia trade tensions could accelerate dollar selling. Federal Reserve actions. Rate cuts could make dollar-denominated assets even less attractive. Asian currency trends. If currencies like the yuan or the Taiwan dollar continue to rise quickly, it could signal a larger shift away from the dollar. Now, let's be clear, the dollar isn't going to crash overnight. But the underlying trends are real and gaining momentum. If Asian countries start moving even part of that $2.5 trillion out of dollar-based assets, we could see global financial markets shift in a big way. Another important development to watch is what's happening among BRICS and Global South nations. Cross-border trade is increasingly moving away from the dollar. For instance, most trade between China and Russia is now done in yuan, not dollars, and both countries are building the financial systems needed to support this change. Just recently, Russian President Vladimir Putin spoke about how Russia and China have successfully transitioned to using their own currencies in trade. He emphasized that this provides a more secure and resilient system that's protected from outside interference. Through timely and coordinated efforts, Russia and China have shifted to national currencies in our trade. As a result, most of our transactions are now carried out in yuan and rubles. This ensures a stable and secure financial system, safeguarded against third-party pressure and global market risks. Thanks for watching. If you found this valuable, please like, share, and subscribe. It really helps. I'll see you next time. Take care.